for joining us. Very good morning to you, Ashish. Thank you so much for joining us on ET Now. I no doubt the markets have seen a very good recovery from the lows that it hit in the month of November. But one of the crucial questions now that will be on everyone's mind is that is India a value buy after the recent sell-off?
Good morning. Thanks for having me on the show. So I think it's great that some of the froth in the market and in the valuations has come off in the month of October. Uh, However, I don't think in terms of multiples, the market has really come into a zone yet. Of course, there are individual stocks that are now much more attractive. But on an aggregate basis, I don't think the market multiples have corrected as much. So even though the market corrected about 10%, if you see over the last 6 months, market earnings estimates are also down by about 4 to 5%. So the multiples for the market have really not moderated very significantly. I think if you look at the broader market, there are multiple stocks that are still trading about 50 times earnings. So I think we still are not in the value zone. I think that's still some time away.
Okay, we're still not in the value zone, but what do you think will take us there in the sense? Do you expect the earnings recovery from here on? Do you expect the multiples to then expand? What will then drive the upside for the Indian markets from here on?
I think it has to be earnings driven. I don't think it can be multiples driven. I think the first half of this year has been disappointing in terms of earnings growth. As you would know, Nifty earnings growth has come down to just about 4% in the first half. For the second half, the expectation is still quite an optimistic 16%. And that's why we have a 10% growth forecast for the full year. I think there is some risk to these earnings. So I think when the earnings downgrades are fully baked in, probably by end of this quarter, and market starts to look at FY26 earnings, where there is high teens growth expected, I think that is when there should be more positive momentum in the market.
Right, Ashish. So since you've said that around 10% growth forecast, earnings growth forecast for FY25, I believe, and we've seen significant actually downgrades come in post the Q2 earnings as well. Which are the sectors that you are now avoiding, given the fact that the earnings have not been good, and you are not expecting a recovery at least in the next 1 to 2 quarters?
So I think actually the disappointment has in earnings has come across multiple sectors. It has come in commodities. It has come in consumer companies. There has been part of the construction pact which has disappointed on margins. Commentary of some of the auto companies has also moderated. We have seen earnings estimates coming down for the financial sector as well. So there has been downgrades across the sectors. I think more than sectorally, we are actually looking much more on a bottom-up basis, on a stock-specific basis. I think there are companies where we believe earnings will be more resilient. We are actually also not really tilting among the market caps. So there are companies in the large cap space which have disappointed in earnings. And after Q2 sharply corrected, while there are companies even in the small cap space which have disappointed on earnings. So I don't think we can broad brush it either in terms of sectorally or really even in terms of market cap cohorts.
Okay, so we can't brush it either in market caps or sectors. Would love to talk stock specific with you, but I'm guessing your compliance would not allow that too much, Ashish. But let me try my luck here and get a better understanding as far as financials are concerned.
Yes.
You're still sticking your neck out and holding more of the large financials, large private financials, rather than NBFCs or PSUs of the world?
So I think in financial, the trend is quite clear that really the banks are holding up much better than NBFCs. We are also seeing diversified non-lenders continuing to do well. whether they are capital market companies, platform companies, and even insurance companies. So I think the earnings downgrades for insurance companies has also now behind us. Of course, there has been news flow on regulatory moves potentially in the sector, but I think that is something that is a concern across the entire financial pack because the regulatory action across banks, NBFCs, as well as insurance companies. So I think large banks and insurance companies within the financial pack look the most interesting to us besides the platform companies.
Sure, but that's the next question then. How do you deal with the volatility related to the overhang of these regulatory challenges? Because obviously there's no way to know it. And some of these are sort of binary events which materially impact the earnings estimates. So what does one do in that scenario?
Sure. So I think the only way to do it is really be really with companies that have multiple lines of earnings rather than one monoline of earnings. You stick with the better management, and as I said, you stick with really the large ones. So the top 2, 3 in any segment are going to be the best place to really meet the regulatory challenges. And you will see because of that, the market share consolidate more and more in favor of them compared to the relatively smaller players in that segment.
Right. Ashish, correct me if I'm wrong, but if I believe that you are overweight on the auto space, but this particular one has seen a pretty rough patch, isn't it? Over the last few months, the
Yeah.
auto sales have not been enthusing for any of the companies. And also, in fact, the month of November also seems to be like a mixed bag is what we are estimating when you talk about the entire auto space. What is it that you are actually liking in the auto space?
So I think within the auto space, there are very clear trends in terms of market share shifts that are visible. So I think across companies, you are seeing very divergent trends in terms of market share shifts, in terms of the new launch pipelines, companies, how they are positioned in different segments. And that is actually also driving how the margin outcomes are coming. So even if you see in the quarter 2, whether in the 4-wheeler space or 2-wheeler space, there were very varying outcomes in terms of margin and profitability for companies. So I think the internal dynamic of the sector kind of make it very interesting for us that there are companies that are gaining market share, that are holding on to margins and earnings much better than some of the peers.
And how are you placed on IT and some of these global kind of facing stocks, the likes of pharma? Because I do believe that you were looking at pharma a bit more positively. Which segment within pharma?
So within pharma, we are still not very constructed on the generic segment. I think some of the CDMO plays is really where there is more excitement. I think IT, we still continue to hold a underweight. I think in Q2, IT actually was one of the few sectors that was that met their earnings estimate, at least the large cap IT companies. But given where the multiples are and even with them meeting their earnings estimate, the growth outlook for IT is not very exciting. So it's still mid-single digit earnings growth expectation, and these companies are now trading at more than 25 times earnings. So I think while IT earnings appear to be more resilient, there is potentially some pickup likely in revenues next year with the corporate tax rate cuts in the US. But given where the valuations are and given where the aggregate growth will be, we are not really overweight this part of the market.
All right, so that's the take coming in on the IT sector. Let's talk about the sector that you did briefly mention about, given the fact that the earnings have not been enthusing, and that has to be the entire consumption space, also the matter of fact, auto space, also somewhere part of it. But what's your take coming in the FMCG space, Ashish? I wanted to get your view on that one because a lot of them were hoping that things would turn around for the better. Now it looks like it is at least 2 to 3 quarters away.
So I think we are getting mixed signals from various corporates. I think we did see rural consumption picking up over the past 2 quarters. And what did this point, however, was that there were clear signs of slowdown in mass urban consumption. The feedback on the festive season also has been mixed. Initial part of the festive season was disappointing. Then we did have a pickup again the month of November, where there was some spillover of festive season, hasn't been as good. There are few companies you would have seen in the past 1 week who have spoken about again some slowdown in rural demand, but thankfully that seems to be limited to a few segments. So we are still hopeful that rural consumption is picking up. I think if you see government spend action both from the center and state, that has turned towards much more on the mass market in terms of the income transfer scheme, the direct benefit schemes that multiple states have now announced. And I believe there are about 14, 15 states, including Maharashtra, that have these schemes in place. And nearly 20% of women are now getting direct transfers of between 1,500 to 2,000 rupees per month. So I think there will be some support coming into mass consumption because of these income transfers. And that should really provide some bottom to the growth in this segment. Again, you will need to be very specific within the FMCG space because really this additional income is coming really at the bottom of the pyramid. So you have to be careful which are the kind of products and commodities that will see a pickup in demand.
Fair enough, but you spoke extensively about rural consumption, Ashish, but what about urban consumption? It's done rather well, whether it was, the high end of real estate or high end of tourism and all of that stuff. With a bit of an urban slowdown, do you think it's time to kind of book some profits out of these ones, or do you think this is a secular theme, which is something that warrants to be in your portfolio for a bit of a medium term as well?
I think we are still positive on high-end urban consumption. I think real estate is one sector we are very constructive on. We are still constructive on hospitality, travel-related sectors. Mass urban consumption has slowed down. Probably that is linked to the fact that there has been a big slowdown in consumer lending. But the top end of the segment, the luxury segment, still continues to do well. So we are quite constructive on that part of the market rather than mass urban segment.
Okay, point taken. On that note, we let you go. Thanks so much, Ashish, for making time and speaking with us today. So that's the latest coming in.